The market is crashing, your portfolio's in the red, and you're wondering, should I sell now or wait it out? Before you make a move that could ruin your long-term returns, pause and watch this. In today's video, I'm revealing the 6 deadly mistakes Singapore investors make during a crash. Plus, I'll break down which REITs to avoid and the ones worth buying or holding to build a cash flow-rich portfolio that can weather any storm. If you're serious about growing your passive income, this video might save your future self thousands of dollars. Stay with me till the end. You'll walk away with clarity, confidence, and a solid strategy for your next move. And hey, if you find this helpful, like this video so the YouTube algorithm pushes it out to more people, and subscribe to Wealth for You for weekly content that builds your financial freedom one smart step at a time. Let's get into it. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research or consult a licensed financial advisor before making any investment decisions. Part 1. 6 things not to do in a crash. First, here's what not to do when the market crashes. These are the mistakes that kill wealth. 1. Don't panic sell. Selling after a 20% drop and putting money into a 2% fixed deposit? It'll take you 10 years to recover your capital. Stay invested, especially in broad, diversified portfolios. 2. Don't try to sell and buy back later. If you didn't know when the market peaked, you won't know when it bottoms. You risk missing the best rebound days. Just 10 missed days can cut your returns in half. 3. Don't short sell unless you're a pro. Short selling means you're betting that a stock or the market will go down. If you're right, you profit. But if the market rebounds, and it often does sharply after a crash, your losses can be unlimited. It sounds smart when others brag about making money during a downturn, but it's very risky and hard to get right. Unless you're a professional with a clear strategy, it's safer to focus on owning good assets and building long-term wealth, not betting against the market. 4. Don't use leverage or borrowed money to invest. Leverage means borrowing to invest. It can boost gains, but also magnifies losses. A small market drop can wipe out a big chunk of your capital and force you to sell at the worst time. Unless you're very experienced, it's safer to invest only with money you actually have. 5. Don't buy complicated products. If you don't fully understand structured notes, knockout clauses, or capital-protected nonsense, don't touch them. 6. Don't chase the market bottom. Trying to time every dip can leave you overinvested too quickly and emotionally stressed. Instead, use dollar cost averaging, or DCA. Invest a fixed amount regularly, regardless of price. It's a steady, stress-free way to build wealth over time, especially in volatile markets. Part 2. What REITs to avoid and buy during a market crash. Now let's talk about one of Singaporeans' favorite ways to earn passive income: REITs. But here's the hard truth. Not all REITs are built to survive a market crash. Some are far more vulnerable than others, and knowing which to avoid can save you from sleepless nights and painful losses. 1. REITs to avoid or reduce exposure to. Let's start with the risky ones. First up, hospitality REITs. These are the ones that own hotels and serviced apartments. Sounds glamorous, right? But when a recession hits, tourists vanish, room rates get slashed, and revenue collapses. And the worst part? There are no long-term leases to buffer the shock. Every night is a new bet. These assets are highly cyclical and extremely volatile. Then there's lower-tier business parks, like those in Jurong Business Park. These are often leased to small tech and fintech companies, but many of them are loss-making startups, and when funding dries up, they collapse fast. Vacancy risk is real here. Once tenants leave, it's hard to find replacements in a weak economy. 2. REITs to hold or consider buying. But it's not all doom and gloom. In fact, some REITs are surprisingly resilient, and even thrive in tough times. Take shopping mall REITs, for example, like FCT and CICT. Think about it. Even in a downturn, people still need haircuts, groceries, affordable meals, tuition for their kids. Suburban malls like North Point City still enjoy over 99% occupancy because they serve everyday needs, not luxuries. Then there's logistics REITs, like Mapletree Logistics Trust, or MLT. E-commerce doesn't stop in a recession. People shop online even more, looking for cheaper deals. MLT's Singapore warehouses are still over 90% occupied, although China assets are weaker due to oversupply. Still, it's a solid space with long-term tailwinds. Office REITs, like Keppel REIT, are another option. They have long-term leases. DBS, for instance, recently renewed a 6-year lease at Marina Bay Financial Center. As long as we don't enter another global financial crisis, the income here should remain stable. And finally, data center REITs, such as Keppel DC REIT. Their tenants? The big boys: Amazon, Microsoft, Google. These tech giants run on data. They sign long leases, and the infrastructure is mission-critical. There are some concerns about oversupply as more centers are built, but if managed well, data centers remain one of the most defensive REIT sectors in today's economy. So, the key takeaway here: not all REITs are equal in a crisis. Focus on essential services, long leases, and strong tenants. Avoid those exposed to travel, tech startups, or industries with rising vacancy risk. In the long run, it's about building a cash flow-rich portfolio, one that pays you consistently and gives you peace of mind, especially when markets turn rough. Part 3. How to build a cash flow-rich portfolio. In a downturn, your biggest strength isn't chasing stock prices, it's having steady cash flow and a solid plan. Here's how you build a cash flow-rich portfolio that stays resilient through any market storm. First, don't get distracted by sky-high yields. Always ask, can this company or REIT actually sustain its dividends? A high payout means nothing if it gets cut tomorrow. Next, diversify. Don't put all your eggs in one REIT sector. A healthy portfolio spreads across malls, logistics, offices, and maybe even data centers, so no single downturn takes you out. And always keep emergency cash. Ideally, 6 to 12 months worth of expenses. This gives you the breathing room to ride through volatility without panic selling. Then, there's dollar cost averaging, DCA. Instead of guessing the bottom, invest a fixed amount every month. It smooths out your cost and takes the emotion out of investing. Finally, think long-term. Don't try to get rich overnight. Focus on becoming cash flow rich, someone who has income coming in consistently regardless of market swings. Conclusion: a market crash isn't the end, it's a reset. And the ones who come out stronger are those who stay calm, avoid panic moves, and focus on quality assets that generate steady cash flow. So here's your game plan. Avoid risky REIT sectors like hotels and struggling business parks. Focus on defensive sectors like malls, logistics, offices, and data centers. Keep your emergency fund intact. And invest regularly, not emotionally. If you found this video helpful, like it, subscribe to Wealth for You, and drop a comment. What's one REIT you're holding or watching right now? And remember, don't just aim to be rich, aim to be cash flow rich. See you in the next one.